Managing money may not be the reason you went into business, but if you didn't learn it, you won't be in business for long. But here's the thing, a lot of entrepreneurs are terrible at managing the books. So today we're going to talk about what you need to keep your cash flowing. Colleen Menchions is the principal with Menchions Consulting, a firm that provides accounting, advisory, and tax services. Thanks so much for being here, Colleen.
Thank you very much, Ronnie.
So what's the first thing an entrepreneur has to do?
First thing is figure out what you're going to do, your scope of business, so that you're not going off madly in all directions. And once you've got a solid plan, the next step is to budget. What do you want to bring in this year in revenue? What do you anticipate your expenses are going to be? What's that bottom line going to look like? Everybody strives for a nice, healthy bottom line, but if we don't have an idea what we want that bottom line to be, we'll never get there.
Yeah, entrepreneurs have that bright, shiny object kind of chasing things, so it's good that, stay focused.
And I mean, finance is an administrative part of your business, and entrepreneurs are passionate about what's driving their business, whether it's the service they're offering or the product they're delivering, and that's phenomenal. That's needed if you're going to run your own business, but you can't lose sight of managing that business as well, and that's where that finance and admin piece starts, and it starts with a decent budget.
How should you structure your business so you always have that cash flow?
So I think the main thing with structuring your business is essentially starting with a budget, which can double as a forecast, a cash flow forecast. So you want to say on a 12-month basis, what do I have coming in the door cash-wise? What cash receipts am I expecting in January? What expenses am I expecting? And you do that through the entire year. And the hope is that you build a little pot so that when you have unexpected expenses, a major piece of equipment fails and you need a repair, or the car that you've been doing deliveries in for the last 15 years says, no more, and you've got to go replace your vehicle. Do you have enough padding built into your model so that doesn't sink your business?
Where do people usually go wrong managing their money?
I think there are three kind of buckets where things go astray. The first is assuming that every dollar that comes in the door is available to be spent. And that's not true. As much as, or as unpopular as it is, at least a portion of every one of those dollars, some of it has to go to CRA, whether it's for HST or for corporate tax, and some of it should go to build that rainy day fund we just mentioned. So I think that's the first thing, is assuming money in is available to be spent in its entirety. The second place where I see entrepreneurs sometimes get themselves in trouble is that they borrow funds from the company for personal expenses, and they don't pay it back. And so then we get to year end, the company could be short on cash because we've spent it on personal expenses. And from a personal point of view, you now have a large tax liability. And then you find yourself scrabbling, looking for cash to pay all of the liabilities that you used to fund your lifestyle when it should have stayed within the company.
Right.
And the other area where sometimes people get themselves in trouble is they mismatch the types of expenditures with the types of funds they're using. So operational revenue is used to fund operational expenses. But if you're going to make a major purchase, buy a building, buy a car, buy an expensive customized piece of equipment, you should be looking at long-term financing for those items, because you want to match your return on that investment with the lifespan of that equipment. So using an operating line of credit to buy a car is not wise when you could very easily finance it over the 5 years for probably cheaper.
Like a lease or a bank loan type thing.
Exactly.
So you talked about, personal versus corporate, which made me think of incorporation. When or should businesses think about incorporating?
There is no definitive point for the when. It's going to be a matter of the risk of the organization, how large you're growing, whether you've got employees, if it's just you. But there are a couple of definite benefits to incorporating. The first is a legal liability issue. So if you are a sole proprietor, you are the company. If you are a corporation, you are limited to what you've invested in that corporation. So for example, let's say you and I start a photography company, and we both invest $5,000 each. We are limited to that $5,000 should we be sued. So let's assume we shoot a wedding and the wedding goes horribly wrong. The bridesmaids are all crying, the bride's eyes are never open, you have not a single photo to hang on your wall at the end of the day.
Let's hope not.
If the bride sues our company, she could take our company for what we have. But we are limited to that $5,000 investment that we personally had. Our personal assets are protected. If we hadn't incorporated, the bride could sue us as the individual, because we are the company.
Right.
And not only is the $5,000 that we've invested in equipment on the line, but so is our personal bank accounts, so are our houses, so are our cars. So the exposure
Our ability to eat.
Exactly. The exposure is much greater as a sole proprietor. The second benefit to incorporating are some tax benefits. So let's assume that we're still that sole proprietor and we've not encountered Bridezilla. So we're making a tidy little living, and this year we bill $150,000 in revenue. If I am a sole proprietor, CRA says that that income, that $150,000, is all in the current year, and I'm going to pay tax on it at roughly 46%. Even though I didn't need to use or spend all that $150,000, it's deemed as income in the current year. If I was in a corporation and I billed out that same $150,000 with the same clients, but I could live on $75,000,
Right.
I would pull out the $75,000, and I in fact would pay the higher income tax of about 40% on the $75,000, 35-40% on the $75,000, and that other $75,000 sits in my company and gets taxed at 14%.
Much better numbers.
Much better numbers, and it allows you to then reinvest some of that money to grow your business. So maybe next year we get $200,000.
What can people do to find the help they need?
I think the best thing is to form a network of advisors, and it doesn't have to be formal relationships. It could just be phone a friend. So if you're not comfortable changing the oil in your car, you find yourself a mechanic that you trust.
Right.
If you're not comfortable reviewing your financial reports, find an accountant that you trust. If you're not comfortable reviewing contracts or drafting contracts for sale, find a lawyer that you trust. And again, these don't have to be ongoing, continuous, long-suffering, expensive relationships. A lot of people are more than willing to teach you the skills that you need so that you can then do it yourself. I think the fundamental thing is to acknowledge what you don't know and then look for support in that area.
That's important advice, Colleen. Thank you so much.
Thanks, Ronnie.